So before we buy, Kevin, there's so much more you need to do before you buy a property. Sometimes we might need to move very quickly, but we don't want to sign contracts until we've obviously made sure we've got our finance in order, and having a good financier there, whether it be a broker or your bank, really understands what you're trying to do. And I'm a big advocate of brokers. Why should I come and see you as an accountant? Because we always say your structure is sometimes just as important as the property you buy. Yep. Can you just maybe elaborate on that a little bit more?
Well, you want to make sure you get your structure right. I mean, not everyone is on the same income as a partnership, you know, husband or wife. Some might have bigger incomes and lesser incomes. And where we've got new property with nice depreciation claims, we want to make sure you're getting the maximum refund on those tax returns. And if we get your structure wrong, we can't change it afterwards, because then might incur stamp duty costs or capital gain costs, whatever the case may be. So, you know, normally you might buy your own home, for example, as 50-50, but as an investment property, we might do a 70-30 split, trying to maximise those tax deductions from the depreciation and special building write-off.
So I just want to go, you just talked about 70-30 split, 50-50. So often when clients are buying a property, if they're buying in joint names, and we'll talk about trusts and in individual names in a second, but if I'm buying a joint name, we get asked, do we want to buy in joint tenants or tenants in common? What's the difference and what are the implications of either or, and what's this 70-30 thing that you're talking about?
Well, typically you'd buy your own home as husband and wife, and you'd buy that as 50-50, which means that if one of you passes away, it's going to go to the other property, the other owner. But when you're buying investment properties, we want to maximise those tax refunds, and if we can split the ownership, then we might be able to split it 99% to 1%, or 70% to 30% to maximise those tax deductions. And that means that that individual owns that percentage of the property. So if we go a 70%, 30% split, it might be one person owns 70%, the other one owns 30%.
So legally they're still 50-50 owners in the eyes of the law, but from a tax perspective?
Not even in the eyes of the law. But, you know, this is one of the common mistakes that the ATO look for too, is that, you know, we quite often get a lot of newsletters from the ATO and they say one of the common mistakes is that one person is claiming all the tax deductions, but the property is owned 50-50. Yes. And this is one of the areas that the tax office, first thing they ask for is, can we see the transfer documents to see how the property is owned? Is it owned as joint owners, being 50-50, or is it tenants in common?